Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. And my email address is rshaw@fxcm.com. Today is Wednesday, and it's the 14th of April. I'm just going to bring up the high-risk investment warning, and I'm sure you're all aware that tomorrow, Monday, public holiday, so this will be the last webinar for this week, and then we'll resume again on Tuesday. Okay, let's bring up our market commentaries disclaimer here. And just the references. So we'll do the analysis market scope. I want to read the European morning article from CNBC, and I think TradingView has a wealth of information. Well, in fact, start off with TradingView. Let's just bring that up. And this is the US10Y. Hey Anna, hey Zanetta, nice to have you all in the webinar. Thank you very much for joining. Yeah, Rob, just taking a look at yours. I did get that email. I beg your pardon. I will respond today. My apologies. I'll do it this morning. Hey Jan, nice to have you on the webinar as well. Yeah, that ZA account is still working. So you can send it there. Okay, so just taking a look at the US10Y. So we're looking at the daily first. So I think the daily is actually easier to analyze than the weekly. And of course, you can see that the daily oscillator has normalized, and it's always sort of a feel-good factor when your base case tends to work out. Nevertheless, you know, the weekly chart is much harder to assess. So we go through to the weekly chart, and the weekly chart is overbought. And see, the problem with the weekly charts is that they can take time to work through that that excess, and we just have to go back to the I use this example all the time, to Bitcoin probably a year ago. I'll just bring that up, and here we go. So, I mean, this Bitcoin over here, this was overbought for 6 months, but that's certainly an anomaly. That I wouldn't expect the US 10-year weekly to remain overbought for 6 months. You never know. But Bitcoin at this stage was hugely influenced on an emotional basis, and that's my sort of interpretation. That's what's reflected in this 6 months of being overbought. We go back to the US 10-year, and of course it's still overbought. So I think we just need to keep this as part of the analysis. Let's just move in over here. Or fear of missing out, friends. Exactly. So what we want to do here is just keep an eye on this week's candle. So let's put in an arrow here. It'll be this one. I'll just put in. And this is actually it looks as if it's sort of a top to the swing. Again, it may look like it, but you know, we don't know. But you can see that yields spiked all the way up to about 282 to 83, and then the yields came down, and we're actually lower now than when we opened. So we opened over here for the week. We're below that at around about 2.68%. And I think there is perhaps scope for yields to come down even further, because that would be in line with, say, a normalization of the RSI. Hey Raj, morning to you. Nice to have you on the webinar. So let's just add in a trend line here of what potentially is going to happen. Potentially, okay. So again, you kind of make inferences. It's nice when your sort of assumptions work out, but it's certainly not always the case. But you can kind of maybe, I think, you expect something like this. Why would we expect ultimately higher interest rates? Why would we ultimately expect higher interest rates? And I think actually we need to bring in the Fed balance sheet at the stage of this discussion as well. Although I hadn't put it in the sources page, I think we just need to bring it in. I'll bring up the St. Louis Fed site, which they call Fred, and I'll bring that up in a moment. And this is what we're dealing with. Let's bring Fred across here. All right, so you want to keep an eye on this 2020 onwards. So we're going to bring this right in. And here you can see is the lockdown period. There's this huge liquidity stimulus, which is what quantitative easing was all about. And then there was just a constant building of the balance sheet, constant injection of liquidity month after month after month, to the point now where the that's ended, right? We know that the QE is behind us, and not only is it behind us, we're now going to see what's called QT. Okay, what is QT? Quantitative tightening. So the idea here is this. What are we looking at here? First of all, it's all very nice to take a look at this. We're looking at effectively the assets. You're looking at the assets of the Fed. So you can see that the assets are building to a point where we almost at $9 trillion. We started around about 4 trillion, and we're at 9 trillion. So more than doubling. So just to give you an idea of what that is, the Fed is effectively every month going out, giving money to fixed income issuers, bond issuers. That bond is an asset, right? If you buying a fixed income bond, you're effectively lending the money, while a loan out on your balance sheet, that's an asset, right? They're your debtor. Okay, so effectively the Fed has pushed that money out into the economy, booked the asset, and now we've got this huge asset balance. And where's that money? Well, that money has been pushed out into the economy. So they'll typically buy the bond from a financial institution. That financial institution lends its money out as well. It uses it to buy whatever it's got to buy. The money goes into the economy. That's what QE is. It's shooting liquidity into the economy. That liquidity's got to find a home, and it found a home definitely in the financial markets. You can debate, whether it's sort of trickled down into the lower sort of strata of sort of, I'm trying to say this as sort of politically correct as possible, the lower classes of the the poorest people, I beg your pardon. So that's a debate, and I think that is a fair debate to have. But the problem with monetary policy as opposed to fiscal policy is that monetary policy is not targeted. It can't be targeted. Fiscal policy can be. Normal citizens. Yeah, I'm begging your pardon. All right. Rash he wishes his equity curve looked like that. Yeah. All right. So that is a debate to be had. But I think, by and large, the results for quantitative easing do speak for themselves. My opinion is that there have been a huge benefit for the jobs market. I think that we've seen wages increasing, and a large part of that wage increase has been for the lower skilled jobs. But the byproduct or the side effect of this is mass amount of inflation. It was also not only because of monetary policy, there's also a huge fiscal side to this, but together it was like a perfect fusion of just inflation generation. So this is going to come down. Now, we're just going to have to do a little bit of work around this just to understand the sort of the mechanics behind this liquidity. So just bear with me for a moment. I want to bring up Microsoft Paint, and all right, so we've got this over here, and what I want to put on my x-axis is what we call money supply. Let's call it quantity of money. That's more correct. Quantity of money. Okay, and here we want to put the price of money, which is interest. Okay, you pay for money through interest. Okay. And then what we have here is a downward sloping demand curve for money. So this is money demanded. Okay, this is money demanded. And just to explain the sort of the negative slope there, clearly the lower the interest rates that we pay, whether it's through our business or as individuals, the more money we're prepared to demand, right? It's cheaper for us. Yeah, let's get some more money. So, and then money supply is fixed at any one point in time. Okay, it's fixed at any one point in time. So here's your first interest rate, and now what's happening with quantitative easing? What's happening with quantitative easing is that there is just keep that back. Is that the money supply shifts out? Why is money supply shifting out? Think about it again. The central bank buys the bonds for money. That money gets shot out into the economy. Well, if there's more money floating into the economy, money supply must increase. Money supply must increase. Money supply must increase. Go back to this graph over here. Money supply is increasing. Okay, and then you get to a point where your interest rate was pretty close to the zero bound, wasn't it? And the real rates were actually negative, but that's kind of where we were. Now we're entering what's called QT, quantitative tightening. We'll make this purple. So what's going to happen here? It's going to shift to the left, because they're going to be, think about what's happening here with quantitative tightening. They're selling the bonds, okay, What's happening when you sell the asset? You're receiving money, so the Fed is receiving that money, and that money is now being taken out of circulation. Being taken out of circulation. So we're going there, there, there. What's happening to the price of money? Okay, price of money starting to increase. What's the price of money? It's interest. Okay, so, and that's starting in May, and it's starting at about $95 billion per month. It may start off a bit slower, but ultimately they're going to work their way up. It might take a month or 2 or 3, but they're going to work their way up to $95 billion per month. And then they're going to just be reducing their balance sheet by $95 billion per month. That means that they're sucking out $95 billion of liquidity from the economy every month, right? And that's why we go back to this guy here. So yeah, we probably overdone, but any sort of dip here would be hugely interesting, because those dips are probably dips in the uptrend, right? So and the reason that they're probably dips in the uptrend, because there is quantitative tightening, more so than just the raising of rates by the central bank. Sure, the interest rates themselves are going to be influential, but I think that this QT is a huge unknown. I think that all the emphasis of the analysis, not all of it, 80% of the analysis should be on how is the QT going to be affecting the economy, because it's a huge, huge unknown. One thing that we can say is that there's going to be higher rates, okay, because just the supply of money is going to decrease at $95 billion every month. Now, there's also side effects of the sales, and I think we've got to have a discussion on that at another time, because the quality of, not the quality, the characteristics of the bonds are very different. 60 billion are just your normal treasury notes, fair enough. 35 billion is what we call mortgage-backed securities, which is tied to the housing market. That's 15% of US GDP, and that in of itself poses a very unique problem, in that it can disrupt a significant part of the US economy. Moreover, the prices of those mortgage-backed securities are going to change radically across the market. Rates of mortgage-backed securities are going to change radically across the market. It has to be managed. So that in itself is, well, I think I need to sort of give that a real thought, and then I think we should open that up to a discussion, perhaps even on a Friday. So this has all kind of been a long discussion, but it has an impact for us as market participants. And what we can do is the easiest, I think, chart to look at with regards to yields is probably the Nasdaq. So I'm going to bring in the Nasdaq here. So let's just go through. We'll click. All right. So what's happening here is that there is an inverse relationship. Let me see how. Let's keep it from about here. So we've gone back to, and I think this is a good place for us to keep the time scale, because effectively the swivel in monetary policy was made late November into December. That's when, in late November, that's when Jerome Powell effectively told the Senate Banking Committee that's time to drop the word transitory. So that he was acknowledging a more malignant case of inflation, and the idea is the yields you can see pop. Okay, so the 10-year yields start popping around there. What's happening to the Nasdaq? into the Nasdaq. Okay, Nasdaq is being driven down on an absolute basis. So on an absolute basis, you can see that the two are, it looks like they are inversely correlated. Now, correlations in of themselves can be what we call spurious. They can be accidental. Just because something's moving up and something's moving down doesn't mean that they are inherently related or intrinsically related. In this case, I would suggest that these are very closely related in terms of the negative correlation. And I think we just need to explore that, because there's an opportunity here. The whole point is, why are we talking about this? Why are we giving this so much sort of airtime? It's because there's opportunity here for us. So let's just go back to Microsoft Paint, and let's get this out. And we've done this previously, but I just need to do it again. I just want to get this a little larger. That's better. Make it bolder so we can all see it. Okay, so we're going to put in some variables here. Present value, that's what the current value of Nasdaq is. Present value. I'm going to put in future value, because that's probably what you saw at sort of, you know, when you did these calculations. Cool. I'm going to change it though to cash flow. Cash flow, I'm going to change to dividend. Okay. Then we're going to put in, we'll just use interest rates here. We're not going to use rate of returns. We're just going to put in interest rates, and then we're going to put in time. So these are the variables we're going to be working with, and the formula will look like this. So it would look like present value, okay, equals, and then it's going to be dividend. We'll just put dividends, okay, dividends over, and here's where the sort of interest rate comes in, and then you put a little sort of so it's to the power of t. Okay, it's to the power of t. Now, what we want to do is we want to talk specifically about Nasdaq here for this. So this conversation you and I are having, I'm referencing Nasdaq. Why Nasdaq? Because that's growth. Okay, it's growth, the growth market. Okay. And what's the characteristics of a growth company? So a growth company, clearly they're looking to ramp up operations quickly. They want to get revenue up quickly. They want to get cash flows up quickly. And the reason, and the way that they do that is they retain earnings. They retain earnings. So whilst you might get a sort of a mature company that is quite comfortable to distribute earnings to shareholders, to pay dividends to shareholders, growth companies don't do it, okay, until they've hit some sort of critical mass. They need to retain the earnings, because that's reinvested. Yeah, that's reinvested. So in other words, if we talk about, well, when do we expect the growth company to give us dividends? It would be logical for us to conclude that, well, sometime in the future, the company has to get a critical mass first. So let's say we're only going to receive our first dividend in 5 years. Okay, let's say that's what, so we're only going to get it in 5 years. A mature company, we can expect a dividend this year. A growth company, but it might take 5 years for that company to sort of reach its growth objective. So we expect it in 5 years. That makes a huge difference in terms of present value when interest rates are fluctuating. So let's just say that the dividend that we expect from our growth company is going to be 100, okay, $100. Okay, and just for the sake of the calculation, let's say that yields, okay, yields are 2%. So we're going to start off with a low yield here. And we're going to just do the calculation as follows. So we're going to, I think I've got all the information I need. We're going to put in 100 divided by 1 plus 2%, okay, to the power of 5. That 5, because we're only getting it in 5 years, okay. Right, now what does that give us in terms of our present value? So I'm just going to throw this all into a calculator, and I get a value of 90.57. If anybody's following me, let me know if you get something different, but I get 90.57. All right. So the current value of this particular instrument is 90.57. Also, just to let you know that this the way I'm working out this calculation is simple. It's a very simplified calculation. If you're going to discount cash flows, you're going to need to do a little bit more work than this. We're not going to talk about that, but you do have to make further assumptions about growth, etc. But again, we're just going to keep it very, very basic because the principle is the same. Let's assume that the interest rate now changes to 5%. What happens now to our present value? Okay, what happens now to our present value? So let's just write it down. All right, so let's just pop this into my calculator. All right, and there's a huge hit on the present value there. The present value now actually is calculated as 78.35. Okay, that's a huge knock. Your present value, let's say yesterday, was 90.57. Now you're discounting at 5%. Your present value has come down to 78.35. That's a big knock. Now we go back to our. Is it any wonder that the Nasdaq's taking a hit here? We're seeing the 10-year yield move up. We're seeing the present value of the Nasdaq coming down. Why would it be? That's just pure time value of calculation, taking into account, with a little bit of sort of complexity involved, because you'd have to work out something called a terminal value and discount it back. Doesn't matter. Principle is exactly the same. So what's the big deal here? Okay, so let's move on to the next step. Well, the next step is, well, we're saying that the yield here is due a normalization. Okay, it's due a normalization. We can see here that the yield has actually got some sort of inverse hammer. We can see if we go down to the daily, actually, that we have already started the pullback process. Okay, what does that mean for Nasdaq? It means that there is probably an opportunity for Nasdaq here before it gets hammered. Assuming that the relationship holds, I don't see why it wouldn't, and assuming that the QT goes on as planned. Again, it could be, we're just working on current information. So the idea here is there may be a bounce, it looks as if the growth market may be oversold. Looks as if the yield market is overbought. Okay, so this is just something to consider, because if we have to go back to what happens if we start at 5% and move back to 2%? Well, that's the adjustment that looks like it's going to be taking place in the yield market. Now, we've got to be very careful here. Okay, I don't want. It's no use to go out and willy-nilly buying Nasdaq because we think there's going to be a pullback. Remember, we're working off of a weekly chart. Yeah, these weekly charts can be very frustrating. Go back to that Bitcoin, just as Anna says, feeding frenzy, right? That Bitcoin stayed overbought for 6 months. I certainly don't see that happening here, but you never know. It would be hugely a huge sort of event. But but the idea here is, I think there is some sort of room for a mispricing here, a sort of an exploitation. So what we can do is we can go through to our, let's just bring up Nasdaq here. Just give me a moment, it should come up. Here it comes. Okay, sorry about that. So what you want to do is you want to see if it's able to get from the weak area into, say, the neutral area. Well, that would be a step forward on a relative basis. Weak into neutral is positive. You can go into the hourly chart. Okay, the longer that we stay in the upper quintile, the more the underlying momentum should support the Nasdaq. Okay, so these are kind of the time frames that we could potentially look to see. Okay, cool, Zanetta. Have a good weekend. I'm going to wrap up in the next minute or two. The whole idea here is it looks as if there may be an opportunity. Again, nothing in the market is definite. So everything is working off a probability or an assumption, and it all depends on how accurate that assumption is. That's why we use money management. That's why we use stop losses. All right, I think we have gone on long enough. We've done sort of mathematics and all this today, so we'll stop here. If there's any comments or questions, just go ahead and type those in. Alrighty, nothing coming up. So let's wrap up here, and yeah, you guys have a great long weekend, a great break, and then we'll catch up on Tuesday. Thank you very much for joining this morning. It's been a pleasure. Thank you, Corbus, and yourself and family. Thank you. All right, guys. Okay, cool, Rob. I'll see if I can find that. Rob's just suggesting a good article on zero hedge. I'll take a look, see if I can find that, Rob. If you have it, perhaps just send me the link. I'll respond to your email. Perfect. Awesome. And then I'll respond to your mail as well. Thanks, guys. And then catch up with you on Tuesday.